Hey, what's up, everybody? How's it going? I am Dan Lohmar, a CFP professional with United Wealth Management, where we specialize in PRAP management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Beal, and I are both pilots for United. Welcome back to another video. Today, I'm talking about retirement income strategies. How do you take that big lump sum of money you've got that you've accumulated over your lifetime and turn that into a retirement income stream while you're retired so you can go out and enjoy the fruits of your labor over your entire career? How do we do that? There's a lot of different techniques out there. I'm going to keep this to a very high level discussion, but I want to just maybe dispel a couple myths and just give a couple broad general techniques, some pros and cons of each one. We're going to keep it to 5 different investment strategies. Hey, if you haven't done it, give me a thumbs up if you like this video. Share this video. Those who are not watching need to hear it the most. I guarantee you that. Post it on the Facebook forum or wherever you can. Email it to your fellow pilots. I can't post it directly on the Facebook forum. And then last but not least, subscribe if you haven't done so. And that's it. And then, as always, it's not tax, legal, or investment advice. You talk to your own advisor and use your own wisdom as to how these situations apply to you. And come and check out our resource library on our website. We got a lot of different cheat sheets, flow charts on there on a bunch of different financial topics. UnitedWealthManagement.com resource library. Come over and check that out. All right, let's jump into it. Retirement portfolio income strategies. Your entire life, you've accumulated this nest egg of investments, cash, bonds, real estate, whatever it may be. And now you're going to retire and you got to turn that into a steady stream of income. That's what we're talking about. 5 techniques on how to do that. And again, big picture type stuff. Hey, 2 myths on this also. I often hear a lot of times, I'm just going to live off the interest and the dividends. I don't want to touch the principal. Hey, that could be something that works, but we're going to talk about some pros and cons of that in each one of these techniques, whether that's a good idea or not, just to dispel a couple the myths that you might have heard. There's nothing wrong with selling principal, and I'll tell you why. Anyway, let's jump into it. What are the things we got to take? What are the things we have to consider when we are designing a portfolio for you? All right, sustainable income. It's got to cover your living expenses throughout your retirement. Do you want to leave a legacy? That's another factor too. Why are these different for everybody? Hey, some people it might be more important to spend as much as they can in their retirement years, not worried about at all about leaving money behind. Some people are more concerned about leaving money behind than they are living off the fruits of their labor. So really, it's really a personal decision as to which one's more important to you. What are things we have to consider in either one of these situations? Longevity, how long you're going to live, cost of living adjustments, market volatility, risk, financial risk, personal risk tolerance, how much can you invest in, still sleep at night, and then the consistency of the approach that we're talking about, which, how consistent is it in producing the retirement income that you're looking for? We always have 2 competing interests when it comes to generating income. One, we want to spend as much as we can, or at least to generate as much income as we can, if that's important to you, or at least sustain your lifestyle. And 2, we also have to make it last. So you can't go blow the whole thing in the first 5 years and expect that it's going to last for 30 years of retirement. So those are the 2 things we always have to talk about when it comes to balancing those 2 competing interests in these different techniques. All right, number 1, and these aren't in any particular order. Probably they're in the order of what I hear the most, but not necessarily the best, not necessarily the worst. Dividends only. So someone says, I'm going to invest in individual stocks or mutual funds that pay dividends, and I'm just going to live off those dividends. That's going to be my income, and I don't want to touch the principal. All right. What are the pros and cons of that? That's the idea of what it is. What are the pros? Well, it's easy. It's easy to understand. A lot of people say that's what I'm going to do. Hey, companies pay dividends. That's my income. Period. I'll adjust accordingly. There is some potential for growth over time. The dividends can grow and the stocks can grow. So that's a good thing about it. The downside of it, dividends can grow. They can also be cut. So dividends are not a guaranteed income stream. They can fluctuate. That is the truth. And then that's the only thing you do, you're somewhat limiting yourself to dividend paying securities. So you could be reducing for diversification. You might be caught in just one segment of the stock market of just high blue chip stocks that are paying dividends, and you're missing growth opportunities. You're missing international opportunities. You're missing bond opportunities. There's just different things like that. So it can potentially reduce diversification in your portfolio if that's all you're doing. Tax inefficiencies. In a taxable account, dividends are an extremely tax inefficient way to invest. And I'll talk about that. In tax deferred accounts like IRAs, Roth IRAs, 401ks, not as much of a factor. But in taxable accounts, there's definitely better ways to do this. And I'll talk about why. So their dividends are not free money. I think that's the myth that a lot of people don't realize, is that if company ABC is valued at $100 per share and it pays a $5 dividend, all things being equal, the day after it pays that $5 dividend, it's going to be valued at $95 per share. So your net worth didn't go anywhere, even though a $5 dividend was issued. So keep that in mind. And if it's in a taxable account, you just created a taxable transaction with no gain in net worth. So that's the thing I like to point about. It's called the ex-dividend in valuation, the ex-dividend date. So again, dividends are not free money. And again, in tax-deferred accounts, we don't avoid them. We don't seek them one way or the other. What we concentrate is the total return of the portfolio, whether that be from growth or dividends or a combination of both. Could a dividend-only approach work over your lifetime? Yes, it certainly could. I think there's probably better ways to do it, though, because the inconsistencies in how dividends are paid out. So, for instance, you might know your dividend payments over the next 1 to 2 years. But because dividends can fluctuate both up and down, you don't necessarily know what your income might be beyond 2 years, because you just don't know how much those dividends could fluctuate. So that's the big thing about it. And again, our technique is in tax-deferred accounts, we don't seek them. We don't really avoid them. But it's certainly in taxable accounts, we do actually go out of our way to minimize dividend-paying stocks inside the mutual funds and ETFs that we use. All right, strategy number 2, interest from income and from bonds. Okay, so very similar approach, except we're just, instead of getting dividends paid out from stocks, we're getting interest coupons paid from bonds. So we have a bond here, pays, typically a bond, high-quality bond pays coupon payments twice a year. You're going to hold the value of that bond. Say you buy it at $1,000 face value, all things being equal, and it's a high quality investment grade bond. When that bond comes due, it's $1,000. So good for capital preservation, and it paid that interest coupon payment the entire time. So what are the pros and cons of this? One, it's a little bit more predictable income than dividends alone. Bonds, high quality bonds, are typically lower volatility, so they do fluctuate over time, or they do fluctuate based on what interest rates are doing. So there is some volatility in bond prices, but compared to stocks, they're typically less volatile. Good at capital preservation because, again, you buy a $1,000 face bond in a high quality company. When it matures 5 or 10 years later, however long you bought it for, you would expect that you'd get your $1,000 per bond back. It matures at face value. So good at capital preservation. The downside of that is the bond itself doesn't grow. So it's not great at hedging inflation and cost of living adjustments over time. So the downsides are, interest rates can affect bond prices at all income levels. So if interest rates did rise, bond values go down in value. So if you had ran into a situation where your income wasn't keeping up with your expenses and you did have to dip into principal in a bond-only portfolio, then you might have to sell a bond at a loss. At the same time, interest rates go down, bond values tend to go up. So those are some things to keep in mind. If interest rates drop from the time you buy the bond until the time that bond matures, you might have to reinvest the bond proceeds at a lower rate. So a little bit of inconsistency risk and interest rate risk there. Again, lower potential for growth compared to equities. If you say, hey, look, I want this income, so I'm willing to take some risk, and I'm going to go out what we call the credit curve. I'm willing to reach for higher yields to get the income that I'm looking for. That also means you're investing in lower quality bonds, like high yield bonds or junk bonds, or commonly know the same things. And so if that's the case too, during economic stress, during recessions or something like that, is low quality bonds, high yield, bonds, junk bonds, they tend to react like stocks during times of economic stress. So they're not as stable. So just keep that in mind. They can drop in value a lot more, sometimes as much as equities do. And then also during periods of low interest rates, if you're looking at just living off bond income during periods of low interest rates, it could take a huge portion of your portfolio to generate the income that you're looking for, just because they're not paying much. And so that's just something to keep in mind there. In a coupon interest only strategy. All right, that's it. Strategy number 3, annuities. All right, what's an annuity? Just first of all, to start out with is, hey, you're taking a lump sum of money, typically giving it to an insurance company. You're paying one time for the most part, and for the rest of your life, they're going to give you periodic, usually monthly payments for the rest of your life. That's the good thing about it. Is an annuity, traditional annuity is designed to last your entire lifetime. That's the good thing about it. It's the opposite of life insurance. Life insurance is to protect your family in case you pass away early. An annuity protects you and your family's income in case you live a very, very long time. So that's the idea of an annuity. So there's really nothing wrong with that strategy itself. But like everything else, there's some pros and cons for sure. The pros of it, yes, it can provide guaranteed income for the rest of your life. It does offer, reduces market variability risk. It's a great diversifier, good for longevity protection. Typically, it'll pay more income than bonds because of what's called mortality credits. And there are some survivor options. So it doesn't have to be just on your life. It might be on the joint life of you and your spouse. So those are some things to keep in mind right there as far as the good things about it. What are the downsides about it? Potentially high fees. Yeah, I think most people would say, hey, you don't buy an annuity, you're sold an annuity. But there's plenty of low cost annuity, plain vanilla annuity products on the market today that you can definitely avoid high fees and high commissions and stuff like that. They can be complicated. I mean, I'm pretty well versed in financial lingo, but annuity contracts are a foreign language to me. I mean, I almost always have to talk to an annuity specialist if I'm trying to read an annuity contract. So they can be pretty complicated. You do lose some liquidity when you do this. Sometimes that's, if you're using 5 to 10% of your portfolio to do this, and you're buying an annuity with that small portion, it's usually not a big deal. But if you took your entire portfolio and annuitized it, and you had nothing to withdraw, you had nothing to pull from in case you needed a larger lump sum payment, yeah, that's something to be aware of. I don't think most people are doing that, but just know that's the downside if you do lose some liquidity and some flexibility when you do that. And then understanding the contract, yeah, potentially you could lose the value, the entire value if you passed away early. Just again, that comes back to understanding the survivor benefits and the early, if you pass away early, what are the provisions in the annuity as far as paying value back? And they're typically not inflation adjusted. So a lot of times it's just a steady stream of income over your lifetime that does not go up with the cost of living. They can be, but that usually results in a lower initial income, or a higher expense with that. So anyway, but that's pretty typical. They typically don't. Forms of annuities, insurance products, obviously. And another way I like to mention this is delaying Social Security and or a pension like PBGC. That's just a form of buying an annuity, because if you delay PBGC or Social Security for 5 years and you're living off assets during that meantime, that essentially the use of of your other investments while those are being delayed, and you're getting the benefit of a larger Social Security or PBGC payment, that essentially is kind of the same thing as buying an annuity. And when you do that, all the pros that come up here, and really again, all the risks of doing that is you're getting both of those by delaying those. So I'm not going to go to the weeds on whether you should be delaying or taking those things early, but that's something to think about. All right, another income strategy here is a bucket strategy. You may have heard this before, where you're taking your portfolio and you're dividing it into basically different time horizons. So you would have a very short-term bucket in cash for 1 year, 2 years worth of income. In the next 2 to 5 years, maybe even out to 10 years, you'd have it in more safer, high-quality investment-grade bonds and bond funds, maybe even an annuity, short-term annuity in there. and then your last bucket would be maybe in equity. So something you're not going to touch for 10, maybe 15 years. So what are the pros and cons of this? Really, the biggest thing is mental accounting. People just like to do this because it's easy to understand. It helps you sleep at night because you know where your next 1 to 2 to 3 years of income is coming from, because it's tied up and it's invested in safe stuff, money market, cash, things like that, CDs. It ensures your liquidity for near-term expenses, helps reduce market volatility. One of the downsides about it is it does require some careful planning, some ongoing management to kind of watch these things, knowing what your expenses are going to be. And then it can reduce your overall return if you have too much of your short-term stuff, too much of your money tied up in the short-term bucket. So that's kind of a downside about it right there. And then a lot of times with this technique, what you see is you might see bond or CD ladders. They come due periodically as those income needs come due, and those are just different ways of kind of filling those buckets up. And then short-term annuities, so an annuity that would pay out over a 5-year period versus your lifetime. That's another way to kind of implement the bucket strategy. All right, so what I like, strategy number 5, this is the last one, and that is the total return approach. And really what this does is, like I said before, none of these techniques are all or none. There's none is the best. I really like to use a little bit of each one of those, and we call it a total return approach. Really, and again, we start out by segmenting your income, kind of like in the bucketing strategy, into different risk buckets. Let's just say that. So again, 1 to 2 years worth of income would be in cash, money market, short-term CDs, stuff like that. The next 20%, and I'm just throwing numbers out there. These can be different, completely different, depending on your risk tolerance and number of other factors. But this should say another 20% would be in diversified, high-quality investment-grade bonds. That provides a nice portfolio income, portfolio cushion, plus future income. And then maybe 10 years out, that would be in stock funds. So this would end up with a 60-40 portfolio. And really one of the biggest differences between this and the bucketing strategy is how we replenish the short-term bucket. So we're not afraid to sell principal whatsoever. And again, I think it's a better technique than the dividend-only approach, because really what it comes down to, the equity side is not the amount of dividends it's paying, it's the total return of the portfolio itself is what the big driver there is in long-term sustainable income. So if equities had a good year, and 1 year went by and your cash assets were down to, they needed to be replenished, if equities had a good year, we would pull from the equity portfolio and we would replenish that, and what was ever left over from the equity side was you put it into the bond side. We try to keep this thing balanced at pretty close to a 60-40 portfolio. If equities were down that year and bonds held up or did better, then we would pull that income from the bond portion side of the portfolio. Would we rebalance completely? It depends. We may or may not. Depends on how far it drifts off of our target allocation. So that's the big thing right there. We could also layer this income. We could carve out a certain amount of that income. Say we're going to delay Social Security and PBGC. So we might even build out a 5-year bond ladder using individual bonds or CDs, and kind of just like we would in the bucketing strategy. And then we'd be building an income floor, a larger income floor with a larger Social Security and PBGC amount. So that's another technique that we're kind of pulling into this thing. And again, as far as like dividend paying mutual funds or stocks, we're not necessarily avoiding them. Same thing with bonds. We're not necessarily avoiding interest paying bonds. It's just that we look at those more of a intermediate diversifier. So anyway, the total return approach concentrates on the total return of the portfolio itself. We're not afraid to sell principal, and we replenish the short-term income needs with the best performing asset class of the previous year. So that's the big things. What are the downside about it? It does require some discipline, some management, some flexibility. We like to use, and of course, on the equity side, hey, yeah, it is You have to be comfortable with the asset allocation, understand the risks and the returns of what you're invested in, because yeah, obviously if it's exposed to the stock market, you can have some downside there too. But again, the strategy, we kind of go back to the bargaining strategy. If the portfolio, if the stock side of the portfolio was down, we would pull from the cash or the bond side to replenish the next year's income. We use what's called a guardrail strategy when we implement this thing. So instead of just saying, hey, we really don't know what our income is going to be from this year versus next year because we don't know what the performance is going to be, then we can set some portfolio guardrails and some income adjustments ahead of time. So at least you know ahead of time what your withdrawal rate from the portfolio would do if we had good years versus bad years. Anyway, so that's the technique we use. We like that because it kind of binds a little bit of everything. Cash reserve technique. This is not necessarily a strategy itself because it's talking about just sitting on some cash for emergencies and whatnot. But this is basically just having, when retirement comes up, you might have some cash, some savings set aside that you don't even want to include for planning purposes. Hey, it helps you sleep at night. Worst case, just a what if scenario. At the same time, you might use it for planning purposes to say, hey, I'm going to live off cash or money market accounts for the first 1 to 5 years of retirement. That way you generate a very low taxable income because that money's already been taxed. It's a low rate of return. And when you're in those early years of low income, low taxes, you can do some Roth conversions with your tax deferred, your Roth, not your Roth, but your 401k or traditional IRA. So that's why we like the cash reserve strategy. Not necessarily a long-term strategy, but it's good there for different techniques as far as helping generate income and a tax strategy. So anyway, that is it. What overall things to consider, again, personal risk tolerance, time horizon, income needs and flexibility, market conditions and valuations, what the interest rates are. These are all factors you got to think about when it comes to generating the retirement income for you. Obviously, a diversified approach. We like the idea of combining multiple strategies and to create balanced income, growth, and risk management. There's, again, not one thing is the best, but it's a common, we like the combination of kind of fitting all of them together into a person's particular situation. And that is it. I hope that kind of answers your question, gives you some ideas of things to think about when you are turning your nest egg into a stream of income that you want to last over your entire life. Hey, if you got questions, feel free to reach out. If you like this video, give me a thumbs up. Subscribe if you haven't done so, and remember to share this video. Those who are not watching it probably need to watch it the most. But anyway, hey, until next time, appreciate you tuning in. Thanks for the awesome positive feedback that goes a long way. Until next time, fly safe.